Welcome. My name is Ken Stack. For those who don't know me, I've been in the industrial inkjet markets now for close to 30 years. Started a few companies. Last one was a company called Jetrion, which was focused on the digital label and packaging space. I sold that to EFI in 2006. Worked at EFI until about 2010, 2011. And after a too short attempt at retirement, I started Proximus. Proximus is an M&A venture capital advisory firm. We focus both on buy-side and sell-side deals. To date, really all of my business has been within the industrial inkjet markets, about $750 million worth of deals in total within inkjet. Companies like MS, Digital Printing, JK, Caldera, Colorgate, Inkmill, Graphtec, et cetera. So it's certainly been a fun ride to watch our industry grow and change over the last 8 or 10 years or so. And I look forward to sharing with you today some thoughts on mergers and acquisitions within industrial inkjet. We'll start with a historical perspective. I'm going to spend about 25 minutes going through an industrial inkjet M&A deal data set that I have that I keep for my clients. It's got about 62 deals between 2012 and today. It'll give us a good perspective on what's happened, but also some of the trends that are changing over time. We'll then talk a little bit about what I see as the landscape for M&A, so different vertical markets, how the action is going to be over the next 12 or 18 months. And then I will try to answer that question of at least maybe what's next. I certainly don't have a crystal ball, but I'll do my best to give you my thoughts. After that introduction, I'm going to introduce two great speakers. Both have been involved in M&A within our inkjet world over the last few years. First is Mike Rottenborn, CEO of Global Graphics. They've just done a very interesting all-stock transaction, very unusual for our markets, to acquire Hybrid. And Thomas Kirster, founder and CEO of Colorgate. I actually represented Thomas in his sale to Ricoh. And so we'll have both sides of the deal table in the interview session, both on the buy side and the sell side. So hopefully you find this interesting. If you have questions, I'll certainly try to attend the chat afterwards. Let's start out with a couple of definitions. First, when we think about mergers and acquisitions and the kind of targets people go after, we want to begin to kind of break down the market into different kinds of companies. And first type, which is sort of the ideal type, the one everybody's looking for, is what we call the unicorn. And in our little world, not necessarily a unicorn like a Zoom or a Google, but in our world, we define that as something with, say, greater than 50 million in revenue, pure digital, growing rapidly, profitable, actionable. Back in the day, companies like MS Systems really kind of fit this description. Today, not too many unicorns around, to be honest, but those are the ones that people always ask about first. Second definition is something a little bit smaller. Let's say it's the same kind of business, fully digital, growing, great technology, but it's kind of small. Can it be anywhere from 5 to 25 million or something like that? We call those pearls. The reason we do is very often when a buyer is looking to enter a market, they use what's called a string of pearls approach. When there's no unicorns available, they go after a number of small companies and string together a strategy around M&A, and we call that string of pearls. The third type of company we're going to talk about is a hybrid. And this is becoming more and more interesting, particularly for our markets. These companies can be much bigger. It can be, let's say, up to $500 million in revenue, but they started as analog businesses. So that makes them very different because usually these companies have a small, profitable, and growing digital printing business, but the overall business is dominated by analog. Now, the interesting thing here compared to, say, unicorns and pearls is very often because they have a large portion of their business being analog, they actually sell for less money. The multiples are lower. However, very often public companies who might be the buyer kind of shy away from hybrids because they don't want that analog equipment or analog business drag on the growth of their earnings because usually the analog side is not growing too fast. So hybrids are very interesting. There's actually lots of them out there. We'll talk about those. Finally, whales. These are very, very large companies, north of $500 million in revenue. Not going to speak too much because for our markets, to be honest, they're kind of few and far between. So this is normally a talk that I give over many, many hours. So we're going to try to condense this down to about 20 minutes or so in total. So apologies if I go kind of quick. Let's first take a look at deal activity over time. So on our first graph on the upper right-hand side, we see a bar chart. X-axis is year, Y-axis is number of inkjet deals in that given year. And in this case, I've broken it by what kind of technology the seller had. Was it an ink company? Was it a software company? Was it a systems company? So if we take a look at our graph, it's actually pretty interesting. We see this big crescendo of deal activity from 2012 up to 2016. Okay. And then it kind of begins to taper off a bit. So 2015 and 2016 were really very, very active deal times. There were still unicorns available back in that sort of 2012 to 2015 timeframe. People began to really believe that, hey, industrial inkjet was here to stay. Okay, so the large buyers came in, particularly public companies, we'll talk about that in a minute, and said, hey, we're going to come in, we're going to invest, we're going to buy tuck-in acquisitions, we're going to do unicorns, we're really going to come and try to consolidate this market. The thing that was pretty interesting in 2015 and 2016 was really the consolidation of the ink business. So if we start to look at the data by seller type, you'll see there's a massive chunk of ink businesses, particularly in 2016. And the reason for that was, if you remember back to that time, there were things like shortages of titanium dioxide, shortages of photoinitiators. Systems companies had grown to the point where they began to realize that, hey, they needed to actually own their own ink technology. They needed to make sure they had not only access to raw materials and access to ink, and they certainly liked the gross margin, but they also decided they wanted control, right? They want to go make a specific formulation for a specific end use. So 2016 showed this huge crescendo of ink. Overall, if you look 2012 to 2019, obviously systems companies have dominated the total numbers. And that makes sense, right? If I'm going to enter into a new market, I want to have a full systems approach. I'm probably not going to go acquire just ink or just software. What you do see, though, is in 2017, 2018, 2019, software starts to come into play. And obviously, as our industry matures, software is becoming more and more important. And so I think you're going to see those software numbers kind of come up over time. Now, one question I get a lot is, well, why did it fall off? Is that a bad thing? You know, what's going on there? Well, I will tell you this. Interest in M&A and inkjet has continued probably at the same level and continues to grow every year. What's happened, though, is we have fewer and fewer targets. And one of the big differences between our market and some of the other markets that are out there is we don't really have a great venture capital ecosystem. We're not creating new startup companies. So if you look at 2015 and 2016, lots and lots of targets. Well, the problem now is that there's too few sellers. There's just not enough targets. We're not generating those new companies. And that is one of the reasons that things have kind of fallen off a bit. So again, systems have dominated the interest. We had a big crescendo in ink up till 2016. And I think deals from an activity level going forward will probably kind of flatten out here. So moving now from seller type to what end use market they're in, also we see some interesting things. So same data, okay, same deals by year. Now what we're taking a look at is what end market was the seller in? What were people going after? And we see the orange there again, 2014, 2015, 2016, even into 2017. That was textile, lots and lots of roll to roll. This was MS and JK and Reggiani and other companies like that. You know, that market, if you think about it, if you step back, it makes a lot of sense for consolidation because, of course, there were lots of companies available. There were unicorns, there were hybrids, there was pearls, lots and lots of targets, very, very fragmented industry. It also fit with, and we're going to talk about this in a second, the public company sort of mantra, which was, look, I want to get into things like fast fashion. Okay, I want to get into fast moving consumer goods. I want to get into a digital business that has a green component, because obviously with digital printing, particularly in textile, there's a massive sort of green upside to it, right, in terms of less waste and effluent and things like that. So it really kind of fit the model. Now, going forward, we've sort of acquired a lot of those. So textile, there's certainly a lot of interest in acquiring companies in textile, but we have very few sellers left. So 2017, 2018, 2019, and going forward, we see a different mix. We start to see packaging coming into play. Packaging today, if I look at my incoming phone calls, by far the most active interest area. Not too many targets, unfortunately, but we will see that going forward. So up through 2016, big consolidation in textile. You see a lot of the gray there, which is quote unquote various. That was a lot of those ink companies, because a lot of those ink companies served multiple markets. So we put them into a category called various. Finally, in terms of deal data set, let's talk a little bit about the type of acquirer. And this is, I think, from a M&A activity perspective, kind of a really big change that's occurred over the last couple of years, and it's only going to continue. Up till 2017, public companies dominated. So I've now broken that same deal data down by who is the type of acquirer. Was it a public company? Was it a private company? Or was it a PE-backed company? Okay. And what we see is up till sort of 2016, just through 2016, we see it's really dominated by public companies. Who are they? Well, they were the EFIs, they were the Dovers, they were the Japanese giants. Okay. Everybody was coming in and acquiring companies. It shifted quite a lot post 2016. Okay. A lot of the reasons for that, if you go back to that time, particularly for the US publicly traded companies, is look, high PE ratios that they had allowed them to do very accretive acquisitions at pretty reasonable multiples. It was growth by any method. They had tons of cash. Investors hated their cash. They said, hey, put it to work, put it to work. M&A was a great way to do that, particularly for EFI and Dover. A lot of cash was stuck overseas, so they could do overseas acquisitions without having to bring it back and get hit by taxes. So a lot of things added into that. But 2017 plus, we see very, very different activity. PEs are now starting to get involved. Private companies are starting to get involved because, to be honest with you, the market's maturing. Okay. There was fewer companies to go after, right? The people like PE companies began to say, hey, this is really a market. This is something that's coming more mature. It's not just this kind of a startup growth thing that the public companies were going to dominate. So 2012 to 2016, we saw a big domination by EFI, Dover, and what I'll call the Japanese office giants. 2017, it's all about buyer dispersion. So what does that mean from an M&A perspective? Well, when I was doing deals back in the earlier time frame, really, there was 5 or 6 or 7 buyers to go talk to. And you kind of knew one of them was going to be, at least one of them was going to be pretty interested. Now, it's a much, much larger set of buyers. It's a different set of buyers. It's buyers that don't know the market as well. It's buyers that have maybe very different views about multiples. So the deals themselves have actually changed quite a bit. You're not dealing with a company that understands necessarily industrial inkjet as well as some of those early buyers, but the breadth of buyers has actually increased. So from an M&A perspective, I kind of look at it as a positive because now instead of having 5 or 6 or 7 potential interesting companies, you may have 40 or 50, but you need to do a lot more education and their deal processes change quite a lot. We'll talk a little bit now about multiples. I've obviously got a lot more information that I share with my clients, but these multiples, first off, come solely from public available data. I never publish stuff that obviously is confidential. Within my deal data set, though, even for my clients, I've got a good number of publicly stated valuations over the years. And again, the thing about valuation is there's no hard and fast rule, okay? There's no perfect formula. Every deal is different. Some companies are growing very fast, some are not, some have debt, some are in very interesting markets, some are not. It really depends. So I really want you to use these multiple guidelines as that just a guideline. Every deal is different, but we can look back at the data and at least get sort of a sense for how these companies sell. First, notice that we used a revenue multiple, not an earnings multiple. Why? Well, for a lot of these deals, particularly for the pearls, they're not making any money. Okay, so there is no earnings multiple. Secondly, it's very rare that even when somebody does publish a deal valuation and a revenue amount, they usually don't publish an earnings level as well. So we tend to use revenue multiples, and I think it's a pretty reasonable thing. So if we think back to our systems companies, these are printer companies, again, like the MSs and the Jetrions back in the day and others. Typically, they sell for about 1.5 to 2.3 times their trailing revenue, okay? And if you look at other markets, high-end robotics, other high-end technology markets, that's pretty consistent, right? And so if you look at pick and place stuff, if you look at other growing technology markets, we're not high and we're not low. Ink and software, much higher multiples, okay? And that makes a lot of sense. These are companies that have incredible amounts of earnings leverage, right? Massive margins. Every extra sale tends to drop to the bottom line. And so again, we've seen much higher multiples, 2 to 4, 2 to 5 times. People are often surprised by ink multiples. And again, very deal dependent, very company dependent. But again, some of these companies have 25 to 35 times earnings or percent EBITDA earnings. So, that's actually a pretty reasonable multiple. Sometimes, particularly in, let's say, the specialty chemical space, stuff selling for double that. So these multiples are absolutely not out of line with software and specialty chemical. Now, OEM components, companies that make print bars, companies that make ink systems, companies that make electronics. I unfortunately always get a call from some of my friends after I do a talk like this where they complain that I've talked down their multiple and know their company's worth a lot more. And look, I love you, but unfortunately, OEM and component companies and integrators are simply harder to sell. Why? They're harder to scale, right? It's that simple. Now, it's not that you can't get a deal done. Very often, strategic buyers are interested in the technology. They're interested in the people. They're interested in your business. Yes. But I just have to tell you, it's probably not going to get done at a multiple like some of those other verticals. It's just that simple. So very quickly, if we talk a little bit about the landscape, let's talk about kind of my view of where the action is coming over the next 12 or 18 months. If I break it down by vertical market, obviously graphics, even pre-COVID, it's a very, very large, very profitable market. You'll see some tuck-in acquisitions. Durst got one done, last year, even in the middle of COVID. I think that's something that you will see some small companies for tuck-ins, but it's not obviously a hot area of activity because the market is pretty mature. Textile, lots of interest, okay, but the unicorns are gone. There's actually only a couple of pearls left. There are some interesting hybrids, so I've got it kind of as a yellow. Yes, I expect some activity, but from a roll-to-roll textile perspective, not the hottest market. Labels is growing like crazy. Great market, probably one of our leaders at this point in industrial, but very few targets. There's a couple of very small ones. There are some interesting hybrids there, but in terms of pearls and unicorns, just not many targets. DTG and promotional, I do expect a lot of activity. Obviously, Corny has from a valuation perspective, just blown it out, doing very, very well. I do expect that market to see a lot of interest, okay, both from industrial inkjet current competitors and outside markets, okay? Because if you think about the whole, sort of Etsy explosion, the makerspace, et cetera, this whole business of print local, this whole business of just in time, it's going to be a big thing. So expect some consolidation there. Laminates, I love the market. I think it's going to be a very important market for us. There are some targets out there, especially hybrids, but not a lot of activity so far, which has surprised me a little bit. So we'll see where that goes. Direct to shape is one that I do expect is going to begin to consolidate pretty fast over the next couple of years. We've got a lot of hybrid players out there. We've got low-end options. We've got high-end options. There's a couple of pure plays. So I think that's a market that really is coming of age. And I do see people, again, both from the industrial inkjet side and outside the market starting to step into that space. Flexible packaging, corrugating, love it. If I had any targets there, it would not be a hard time to sell them. Just not a lot of targets. And again, when we talk about that venture capital sort of restart ecosystem that we don't really have in our business, it's interesting, right? Businesses, for example, in corrugated, you're seeing lots of new product launches, which is great for our markets, but there's no startup companies doing it. It's all the entrenched players. So at this point, from an M&A perspective, it's really just a lack of targets. Ink, we talked about ink during one of the last overheads. We've seen a lot of consolidation, not a lot of targets, lots of interest. Lots of companies have interest, particularly in acquiring ink technology, ink formulators. So I expect some activity on the few that are left. But again, that's really an area where we're kind of running out. Software. This is a hot space. We've got two people who are going to speak to us about it in just a few minutes. I think the value of software is growing in our markets. I think our systems companies are doing a much better job actually trying to extract value for software, not just bundling it in and giving it away so they can get a printer sale. So I think that trend continues. I think software companies have a lot easier time starting up, particularly from a funding perspective. So love the software space, expect a lot of activity there. Printhead OEMs. And this is one disclosure. I hate it when people give talks and they don't disclose that they may have an investment there. I do have a personal investment in a next generation printhead startup. The printhead markets from an OEM perspective have obviously consolidated, really driven again by the Japanese giants, Czar, and there's a few independents, but really that's a market that's consolidated. So not going to be a lot of core M&A activity, I think. However, this is really one of the few verticals in addition to software, where I do see startups coming, and I do see startups that potentially have a lot of value in them going forward with very different technologies. This is not stuff like a next generation piezo head or something, mostly being driven by markets like 3D print, print for manufacture, going after very, very difficult materials, extreme viscosities. Okay, so think about printing direct with flexo ink or screen ink or something. So I think there's going to be a lot of interesting activity in sort of the VC angel, seed round, A round space there. So not typical M&A, but more on the VC side. So we'll see what happens there. And finally, my friends on the component side, there's lots of them. Kind of tough to sell. The strategic buyer has to be very, very interested. It's as simple as that. Lots of acqui-hire opportunities, though, for the larger guys that are looking for more resources. So I've got about 5 minutes left. Let me try to finish with a bit of a discussion around what's driving M&A activity, what's driving some of our market dynamics. And I took these just from sort of discussions I've been having with some of my clients. So first, obviously, can't talk about anything these days without talking about the COVID effect. If we go back to April, I'm getting phone calls from clients saying, "Hey, I didn't sell any ink this month." Right? It was looking pretty dim. Now, fast forward to now. If you're in the ceramic space, if you're in the packaging space, if you were in the DTG space, the software space, I suspect you're doing quite well. Okay, I suspect business is at or above where it was last year. Display, roll-to-roll textile, kind of coming back a little slower as you would expect, but long term, I'll be honest with you, I think they're going to be fine. We are going to get vaccinated. We are going to go back to sporting events. We are going to start to travel again. So I expect even those businesses to come back at least to their pre-pandemic levels. So from a COVID effect, what I really see is a lot of FOMO, fear of missing out. People are really itching to go do something. In terms of my incoming phone activity on people interested in M&A, instant strategic things, it's way above where it was at the same time pre-COVID. So I don't see a long-term COVID effect here in those markets. We'll talk about the office giants in a second. So market dynamics overall, I think we're really quite solid. And remember, a big part of that was the central bankers around the world, right? If you think about what governments did during the crisis, I don't have a single client, small or large, that didn't take advantage of some sort of government program to cover costs, cover people during the pandemic. But now it's done two things. One, it's allowed your customers, your end customers, not only to have survived, but odds are they're pretty flush with cash from two things. One is stimulus money. The second thing is the access to subprime and prime industrial credit has never been higher. Okay, so your customers can go get those deals financed for that $400,000 or $500,000 printer much easier now than they could pre-COVID. It's a pretty incredible thing what the bankers have done. And we could talk about if this is a good thing and flooding the world with money and, is the long bond going to hit 3% and then we're all going to be back into the depression again? I don't know. I don't think so in the next 12 or 18 months, but central bankers have really had your back. The other thing I get a lot is relative particularly to the Japanese office giants. Hey, they have to move into industrial inkjet harder. They have to come by my company because, oh my gosh, their core toner business, their copier business, it's going out of business, right? And if you look at the losses of some of those large office giants, they're pretty brutal. They are seeing a structural change. Now, what does that mean to us in industrial? Well, remember, the office giants are the ones that have been funding all that printed development over the years, right? In addition to that, they're now pretty big players in our market. So it's important, I think, to think about where they're going pre-COVID versus post-COVID. Well, the central bankers, again, to be honest, have saved a lot of it. If you look in Japan in particular, they're borrowing at virtually negative rates. And you can argue that some of them have frankly become, almost zombie companies that are barely able to pay their debt, even at these low rates. But they're there and they're staying there. Okay. And so what that means is, I don't think they're going to see a huge change in their behavior. I don't see them having to go crazy and go start acquiring all these industrial inkjet companies. In fact, to be honest with you, if you look at the total dollars that they've got to replace for the loss in their copier markets, if you added up the entirety of the industrial inkjet markets, it doesn't really even scratch the surface. So I expect sort of more of the same from the office giants. I don't expect to see change because those central bankers, one way or the other, save them. So we're going to still have access to print heads, but I don't expect a big boom in M&A for one. Seller shortage. We talked about the fact that we don't have a lot of startup companies. I think that on the seller side, we are going to get more sellers into the market. Okay, COVID did scare some of them, right? When you don't sell anything for a few months, Some of the people that I've known over the years who were kind of not up for selling, they've begun to rethink this. So I think we will see some more sellers. Shifting buyers, I continue to think the dispersion of different kind of buyers continues. I think that's a good thing for our markets. Multiples, this is always a hysterical discussion. Post-COVID, I'm getting calls from sellers saying, hey, well, look, the office giant's got to move in. I should be able to sell my company for double now. Well, probably not. Okay. On the other side, I'm getting calls from potential buyers saying, hey, well, these, little inkjet companies, they got to be going out of business. They got to be scared. So let's go in for half. Well, no, either. I really do see kind of stable deal multiples going forward. I don't see a sea change here. Last topic, always a fun topic, SPACs, IPO listings. We see the world is exploding in cash, and we've, driven the markets up to all-time highs. I am getting calls from some people saying, hey, I've got 10 or 20 million in revenue, and Desktop Metal just went public for $4 billion through a SPAC, and I'm about the same size. So can we SPAC this? Well, look, I'd love to SPAC you. It would make my day to SPAC you. But here's the difference. They're looking at markets that at least they've convinced the investing public that there are many, many, many times the size of ours, right? If you go look at the SPAC deck for Desktop Metal, they claim that the direct, metal printing markets that they're going to be in are going to be worth $20 billion in less than 10 years. If you took the entirety of all of our industrial inkjet businesses and added them all up together, we simply don't get to those levels, okay? So if you think about people that have been successful there, think about the Desktop Metals, the Nano Dimensions in the printed electronics space, the X1s. And in our little market, Kornit's a good example. They're trading at 40 times revenue or something like that right now. They're the only one that's been able to convince investors that their end market is so big that it justifies that kind of multiple. Okay, it's not just about the tech. Yes, they all have great tech. Yes, they all own proprietary technology. But at the end of the day, right, it's really about the end market. Now, for us, is that a bad thing? Yeah, again, I'd love to SPAC something in our markets. That would be great. But here's the other side of that. Our markets are stable, right? Our markets are solid. They're going to do fine. We're growing nicely. We're profitable. We have consumable streams. We have ongoing investments. So overall, I think things are actually pretty good. So any questions? Be happy to answer them afterwards. And let's move over to our speakers. Well, welcome back. I'm excited to have two leaders of the software area for Industrial Inkjet with me today, both that involved in M&A. And interestingly enough, on different sides of the deal table. First, I've got Mike Rottenborn, who's CEO of Global Graphics. Global's been a serial acquirer in our business, very experienced. Mike's going to talk to us a lot about his background, Global, and his views on M&A. We've also got Thomas Kirshner with us. I was privileged enough to be able to represent Thomas in his sale to Ricoh almost 2 years ago now. And Thomas is going to give us not only the seller's perspective, but also this perspective on what it's like to be a founder of a company and then become part of a larger organization. So to both of you, thank you very much for joining today. I really appreciate it. Mike, why don't you start, if that's okay? Give us a little bit of background on yourself, a little background on Global, and let's go from there.
Absolutely. So I've been in the graphic arts and packaging industry for 32 years. I don't feel that old, but I guess I am. Originally, I studied electrical engineering and later computer science. So I come from the technical side of the industry rather than the business or the entrepreneurial side of the industry. My first employer out of school was DuPont. So I worked in DuPont with Crossfield Electronics and later their packaging business. Shortly after that, I worked for Artwork Systems, which was a Belgian packaging software company. And my boss at Artwork Systems was a guy named Guido van der Schuren, who's still the chairman of Global Graphics today. So I've had the privilege of working with him for nearly 25 years as well. I actually was the founder of Hybrid Integration, which is one of the companies that later became Hybrid Software. So that was back in 2007. That I left Artwork Systems and founded Hybrid Integration. So it's really a pleasure to see things come full circle and have Hybrid Software now as part of Global Graphics. So who's Global Graphics? We're a PLC. We're headquartered near Cambridge, UK, in a town called Camborne. And we're publicly traded on the Euronext exchange. So we have 4 companies that comprise Global Graphics today. Global Graphics Software, creates the Harlequin Rip, the Mako Toolkit, and other products like Screen Pro and Print Flat that have been in the news lately for inkjet quality. We own Meteor Inkjet, which is a hardware and a software company that make print drive electronics and software that primarily is sold to OEMs of digital printing equipment. We also own Zytron, headquartered not far from you in Ann Arbor, Michigan, Ken. Zytron was
I know them well.
I bet. They were the largest reseller of Harlequin, but they also create their own OEM their own OEM DFE for companies that use printheads from Memjet as well as from HP. And then finally, we recently bought Hybrid Software. So Hybrid Software is the newest part of the group. They actually sell primarily to end users, although they have some OEM business as well. And they're very strong in the labels and packaging, so PDF editing and workflow for labels and packaging. So together, those four companies comprise Global Graphics PLC.
Great. Well, thanks again for joining us, Mike. We're looking forward to the discussion. Thomas, how about yourself? Can you give, I think, again, most people know you, but for those that don't?
No, it's my pleasure. Yeah, actually, I'm out of Hanover, Germany, and those of you that have been in the industry for a while, they may remember CeBIT trade shows. They used to be the largest trade shows for computers back in the, I would say, 80s. And this is actually how, that thrilled me when I was a kid. So I'm a clear CeBIT computer kid, and I had a dream to found my own computer kind of company. And so this is what I did. I studied economy, and I had my first ventures in computer graphics, computer animations. I was blessed really to start with Inkjet back in 1993 when HP was looking for someone to look into the wide format graphics. So that's when my first company started reselling, distributing wide format equipment. This business was later merged with two other German businesses, turned into the German-wide distribution ship, and I sold this company actually to Fujifilm back in 2007. And I founded Colorgate together with a partner coming from the signage business, and we met back in 1996. Started the Colorgate as a, let's say, planned venture, and I stepped into Colorgate full-time in 2001 when my former business was merged. And since then, I've helped to develop the company, and Colorgate quickly became a leading player in the wide format sign and display market. And after a while, we kind of identified that there's a new market upcoming, industrial inkjet. And this is what caught our interest. And that's where we focused Colorgate on, and became the leading software supplier for industrial inkjet applications software-wise in Europe. And at a certain point, we decided that we are let's say, we've reached a certain point where we couldn't really develop the company to the next step. And that's probably why I'm here. And thank you, Ken, for the invitation.
Of course. Well, thank you, Thomas, for joining us. So I'm going to ask you both some questions. Hopefully we've got in our audience, remember, we've got folks that are from large companies that might be acquirers. We've got founders out there that are in a similar position to what Thomas's was. So as you guys answer these questions, maybe just try to think about sort of both sides. So Mike, let's start with you. You know, you just finished what I think for our little industry, certainly from an AM&A perspective, was a very interesting deal, right? You guys just did a deal to acquire Hybrid. It was an all-stock transaction, kind of unusual for our little industrial inkjet world. Maybe you can talk a little bit about not only the reason behind Hybrid and the strategy, which I think most people will have a decent understanding, but tell us about the mechanics and why you went with the stock deal and all the things that were involved with that.
Sure, absolutely. That's a great opportunity. And as I said before, I was an early founder of one of the components of hybrid software. So, this brings it full circle back into Global Graphics. That made the deal interesting because both myself and our chairman were conflicted in the deal.
Right.
So, that was publicly disclosed. And some of the board meetings involved the independent directors, but not Guido or myself. And we had to be very transparent and really communicate both to the shareholders and to the regulatory body, the FSMA, on many aspects of that. So why was it an all stock deal? Mostly because it was possible to do that because Guido was chairman of both hybrid software and of Global Graphics.
Okay.
So he could understand the future value of Global Graphics in a way that many people who are selling a company or selling their life's work or their crown jewels may not be privy to the future potential for that company as part of another group. So, normally an all stock sale would not be something that an entrepreneur is looking for if they want to exit their business or sell it to somebody else. But it was a perfect fit in this case. And of course, it's good for Global Graphics as well. We did not have to take on any debt.
Right.
There was a small amount of debt that came along with hybrid, but we did not have to borrow money in order to purchase hybrid. So we're able to issue the shares. We actually have an annual report coming out this week, and then a prospectus will follow a couple weeks behind to make public the information on hybrid's financials and the inside mechanics of that transaction. So, as far as the valuation, we did have an independent valuation study done. And, as you mentioned in your intro, your software is 2 to 4x the trailing revenue multiple. I think there's more to it than that. And we can talk, in some more detail.
Sure. Definitely. We're going to come to that for sure.
So the hybrid transaction was in that ballpark, at the high end of that ballpark, as you might expect.
Absolutely.
It was very strategic for Global Graphics. It gets us into an end user market where, frankly, the margins are much higher. The components we sell, we sell a Harlequin rip to hybrid. They sell it as a component of a workflow at a much higher price, of course, than the components that build that workflow. And it brings Global Graphics more deeply into labels and packaging, where there's an awful lot of activities these days, both with OEMs, the traditional customers of Global Graphics, and with end users, the traditional customers of hybrid. So I think, a common thread in this discussion, at least for me, is probably going to be synergy. That the drivers for a deal are not just the financials, it's the synergies and the unexplored potential of bringing two companies together. And that's never more true than in the case of hybrid. So hybrid, on the surface, they roughly double our company. They double the revenue, they double the number of employees, but they really bring a very different mix, much more of a local presence in major markets, a much bigger sales and support team because, they're supporting end users in various markets throughout the world. So it's a very different model than the traditional OEM sales model, and it's very additive to what we do.
Great. And we're going to get back to your valuation point in a minute.
Absolutely.
Because I think your point around it's not just about the numbers, right? On a strategic deal like this, it's really about the fit and the unrecognized upsides, right? And that's the whole point. 1 + 1 hopefully makes 3. And obviously in this case, you guys certainly feel that way. So that's exciting. So we're going to come back to that in a second, because I think that's a great lead in. Thomas, let's now take a look a little bit at the seller side, the founder side. When you and I were doing the deal for Colorgate, we were talking to many different companies, obviously, that had interest. Something that you always said when people asked you the same question, which is, hey, Thomas, why now, right? Colorgate's doing well, it's profitable. Why was it the right time? And more importantly, I remember your line, your answer was always, you want to take Colorgate to the next level. You said that over and over again. So tell us a little bit about your thinking there, but also how that's now actually come to fruition, right, under Rico.
Yeah, of course I will. So it's actually, so by that time we already had 20 plus years in private ownership with all the, let's say, ups and downs. And so this led us to, let's say, a good and leading market position in Europe, but still with ever limited resources. Yeah. So all the money that you would make, you would reinvest, build the team, do it, working with banks and so on. And of course, kind of trying to keep the risk at a level that you can bear it private ownership. And this, after 20 plus years, came to a point, and by that time also my partner, he had already crossed the 60 plus, and he was more looking to, okay, what's next in my private life. So this brought us to the decision, okay, let's have a look for a strategic investor that really understands the kind of jewels, or you call it the pearls in your presentation, and that values this, and which could also bring synergy and actually bring it to the next level. And the clear next level for us is was to conquer other, let's say, global markets, the US, extend our presence in Asia, in China, Japanese market, etc., etc. And so this was one of the key reasons. And when you're quoting me, but also there were some other influencing factors. So by then, also all leading competitors from the sign and display wide format markets had already found a home with a strategic investor, and which wouldn't make things easier for us as a private independent company. And the key was, there was also an element, looking back, I kind of followed my intuition that I said, okay, and if you've had your own business, you know this. It's like your own baby. But I had the intuition, okay, you need to kind of release it and also help the team to grow further and bring it to the next level. And I'm happy that I actually refound you in helping us and supporting us and going through the intense process. And I'm still happy about the great decision.
Awesome. Well, thank you for the kind words. I now owe you another free dinner or something like that for those. That was very nice, Thomas. Mike, let's jump back to that valuation discussion, okay? Because valuation, when I have this discussion with people, I always say, look, there's ranges, there's generalities, every deal is different. But let's talk about, if I'm on the other side of the table, if I'm a founder coming to Global Graphics, okay? And you're looking at my business, how do you think about value? As you said, it's not just, a trailing amount of earnings or a trailing amount of revenue. That's a factor, of course, right? But how do you think about synergy? How do you value synergy? How when someone's approaching you, should they approach you?
Absolutely. And I believe I think that there's a successful deal at the intersection of the financials and the synergy from both sides. So the seller needs to be viewing the deal drivers from the buyer's perspective, and the buyer needs to do the same in reverse. So, it's to me, the first thing you have to start with is culture. A lot of acquisitions are not necessarily successful because the culture doesn't survive the acquisition, and what made the company special before is no longer present. So the first thing you have to do is make sure that there's a cultural fit. And if you're a founder of a company, that's your baby. You're equally concerned that this is a good fit on the receiving side, on the purchase side of that acquisition. So, the culture has to be evaluated both ways. Number two, I think you've got to see the synergies before the market does. Is this a good fit, for the combined company that goes beyond just what the numbers look like? Thirdly, I think you've got to take a look at, are there technology elements or attributes in the company you're buying, as well as key people? You've got to remember the human resources are just as important as the technology. You can have source code escrows all day long, but without the people that wrote that code, they're not worth very much often. So, again, you have to look at the technology and the people. The acquisition of Meteor back in 2016 was a great example of this. Global Graphics bought Meteor, and it really increased the scope of their business far beyond RIPs and software into printhead drive electronics and software there, and pulled Global Graphics squarely into the heart of the industrial inkjet market.
Great. That was a great answer, because I think, again, people get so focused on, is there a simple metric? Is there some multiple of earnings? I think we all know for a successful one, it's got to be a great fit, and the strategy's got to be right. Without the strategy and the upside, there's really no point, is there? These are not just some simple financial transaction. Thomas, let's go back to the founder side. Let's talk a little bit about process, because I think certainly in my business, I spend a lot of time talking to founders and sellers about, a deal process is kind of long, it's kind of tough, right? What were some of the things that surprised you during the deal process? Okay, in terms of things you probably didn't like too much, and then talk a little bit about your own role now. What's it like post deal? So let's try to hit both of those quickly.
Yeah. So yeah, it wasn't, as you remember, probably it was an exciting, but also a very intense process that took over half a year. And I think this is I probably underestimated a bit prior. That is, this comes on top of your daily work. Yeah, it's not that someone else is doing the work, and then you just focus on getting the company sold. So this, but other than this, surprises during the process, I would say surprisingly enough, there were no real surprises during the process. But I think that's probably because we followed your advice to do the work up front, prepare well, yeah, and have everything transparent, including also the not so attractive and not so positive things. So lay them out on the table. And I think that's the right way that we did. So we could explain all the things, and there were no surprises during the deal. But maybe on at second thought about surprises, of course, I was pretty surprised how detailed and how much attention was paid by a large company to a relatively small business. Yeah, Colorgate was less than 5 million in revenue by that time. So this was quite some surprise, the detailism on the due diligence. But of course, everyone wanted to make the job as good as the process requires it. Yeah.
Yep. No, it's very fair. I mean, I think most people, by the way, are surprised at the level of detail a buyer gets into. And I think, for our listeners, I think, one of the things to understand when you have a large public company looking at a small company, they do view risk pretty harshly. Okay. And they have to understand those risks. Right. They have to sell those risks to the levels above them. And so you will be surprised at the level of detail that they're going to get into. And I think that was certainly the case here. Thomas, tell us a little bit, though, about your new role. Tell us about what's it like for a founder now inside a big company. You had no boss for many, many years, other than maybe your spouse, right? And now you've got an actual boss at work too.
Right. But this was an experience that I was looking forward also to enrich my personal career and life. And I can say, so luckily, Colorgate ended up with Ricoh, and Ricoh, the leader in digital imaging, and also in their mission to transform into digital services and be and grow as the leader in industrial inkjet. It was a perfect strategic fit. And I think they also made clear during the process that they understood the value of Colorgate. And so what changed for me, I think on the positive side, it was really that we really got resources now in, let's say, adding people to the team, real pros for marketing, for sales. We could increase our development team, and we could actually take a longer perspective. Yeah, when I had my own business, it was always like, okay, you invest into something, but it better pays back within the year or in 18 months. And now it's really interesting to see that, of course, the planning is much more than we used to do, but it's good. It's interesting, and I'm really it's an exciting and a good experience to also the access to let's say intelligence, to data that as a small firm you cannot afford to buy the expensive reports, but now we've got access to this. We can analyze the markets that we want to go after, look closer at customer demands, and this is what is now helping us to really think on a longer perspective, develop new solutions that are different to the things that everyone else is doing, and this is really great. So we've also continue to develop into an end-to-end solution. So coming from e-commerce, online kind of customization, visualization, and go all the way through towards directly into our production systems for many different industrial print applications. And this is kind of a vision that I may have had in the past to serve our customers better, but only with RICO-specking we actually found the means to do this. And yeah, that's great. Great. Maybe on the other side, I think in terms of the downside, it's a bit that you need to report in much more detail, and you need to argue more on the rationale. Why are you doing things? And so I try to listen to my kind of intuition and gut feelings, but now you have this second element to explain it to someone else than yourself. Yeah.
No, I understand. Yeah. And it's interesting, during the deal, we had a lot of discussions about that, and I think that as you guys, as you grow, that is a necessary thing, right? You have the reason someone's interested in acquiring a small innovative company. You have the gut feel, you have the ideas, you have the knowledge. Now they're going to bring some process and hopefully allow that to scale. So that's great to hear. Mike, let's jump back to you. Another sort of a deal question for you. You guys have been a very active serial acquirer. Okay, you've also sold some businesses too, which is interesting. Obviously, over time. Let's talk a little bit about COVID, right? So we've just hopefully we're starting to exit out of the COVID period. Hopefully, our friends in Europe get back on track with their vaccinations and things based on the news today. But we're hoping that we're all heading out. You guys actually were doing a deal during COVID. Right, I believe you're the font factory, I believe it was called.
URW, yes.
Yeah, yes, exactly. So tell us a little bit about how you managed through that, right? Because you guys were able to get a deal done. Hats off to you. That was not the easiest moment to get things done. So great job. But I'm sure there were some bumps in the road.
There certainly were. And I guess for me, it's easier to buy than to sell. That seems to be true in investing, and it's true in companies as well. You have to think about, first off, what does it do to change the strategic direction of the company that's doing the selling? And in the case of URW, fonts, it was a great business. It was very profitable, but fonts were more important in the PostScript world than they are in the PDF world. If you receive a PDF, it contains the fonts, at least the glyphs that are required to display or to print that document. That wasn't true in PostScript earlier on. So URW's target market had moved further upstream of where we were selling. Fonts are very interesting to corporate brands and to designers, and we were selling downstream much closer to manufacturing. So URW was less strategic to us and found a very good home in Monotype. Who knows how to sell to the brands and the corporations and things like that. We did have a letter of intent signed with Monotype before COVID came along. And as we're proceeding through the due diligence, all of a sudden the world changed. So did the deal. And it was a lot of hard work to bring the deal back to something that was close to what it was before. With similar payment terms. Really during COVID, nobody knew what the world was going to be like back in April or May. And this deal closed in May. So in some ways, it gave us more motivation to complete the deal. And the cash that it brought in gave us some security to weather what I think has been the worst of the COVID pandemic. So, very interesting time to do the deal.
Yeah.
And, again, it came back to what I said before. You had to put yourself in the other party's shoes. What are the drivers for them? And, is there some common ground there? So we were very transparent in the negotiations and ultimately was successful.
Well, tremendous job. That was not the easiest period to get something sold. That's for sure. And it sounds like it worked out very well for everybody. So that's great. Let's see. We've got about 10 minutes. So I want to ask both of you a question. Tell me a little bit about one of my pet peeves in deals. If I look at the deals that I've done, ones that tend to work out well, did a great job with post-deal planning. Okay, because we spend a lot of time on the deal. We're going through financials. We're crawling through businesses like Thomas's with a fine tooth comb and finding every little nickel and dime and issue. And then, if I look at the breadth of deals that are done in any industry, not just ours, very often post-deal integration is neglected. Okay, and it's not the fun part of the deal, but it's actually, for me, I think, a very necessary part of the deal. Well, maybe both of you can just give me a few minutes on how you, first for Mike as generally a buyer of business, how you view the planning, and Thomas, if we think about the post-deal planning we did, right? How did that sort of work out? What would you have done maybe a little bit differently and worked out well? So Mike, why don't we start with you, and then we'll jump to Thomas.
Sounds good. So you have to remember, when you're buying a business, you're paying a lot of money for that. And that money is a responsibility to your shareholders. It's also an opportunity cost in terms of what else you could have done with that money. So I think it's really important to treat any new acquisition with kid gloves. You have to remember that an acquisition brings uncertainty on both sides of the deal. The company that's being acquired, sure, every employee there is wondering, how do I fit in? But that's also something that a lot of people are wondering, even if they're on the buy side of a transaction like that. Really important to be careful in how you integrate culture. I think you need to take time and limit the unnecessary integration. You should never force a change just because, quote unquote, that's the way we do things here. To me, that overlooks people's feelings. And again, you can very easily lose what makes a culture magic in a small company. And before you know it, what you thought you were going to get, you lose key people, or you lose momentum on the technology change and things like that. So it takes a lot of planning. It takes respect of the culture and getting to know the people, not just the management team, but all of the people that are a part of the company that you bought. And again, it takes time and a very careful approach to end up with a good outcome.
Mm-hmm. Great. Mm-hmm. Thomas, give us your side, right? So we went through a transaction with a multi-billion-dollar company. You were very small. How has post-integration worked out compared to your thoughts?
Yeah, it was, I think, important is also that to have some consciousness. Okay, what do you want to do after it? What is the vision for the company? And as I laid out, so I had some plans, some ideas that I wanted to pursue further. And there was one important also common ground between Ricoh and Colorgate, that the agreement was that they keep us as a separate brand. And this was, I think, important. It is still. As we also serve other OEMs that are partly competing with Ricoh. We work with dealers, we work with customers, and we wanted to continue serving them. And I think this has worked out well. So we still have this kind of core business that Colorgate is pursuing. On the other hand, we have this synergy part where Colorgate is serving Ricoh, the industrial print business group, with software solutions for color management, for printer drivers of their systems, and more and more their component business, to actually jointly approach new customers. And yeah, so this requires a good vision, and of course, as I was mentioning, the detailed planning. And so I have to say, we got really professional, great support. And I've heard this from other fellows that have sold their business, that they ended up in endless, let's say, PowerPoint meeting decks, which they needed to create. And I'm really happy to report that I've found great colleagues that do a great job at this, and so I can do the talking, the visioning, and maybe the correcting of the decks. Yeah, that's so this has worked out well, and yeah, as I mentioned, it's yeah, business goes on, life goes on, and it's yeah, but also the workload and time that I'm spending with the business has grown. This is maybe a little bit the downside. That that's I wouldn't expect, but I do this with passion and excitement, so it's not so tough.
That's great. It's great. Well, it's good. I think, again, to me, this is a key part of deals that are not done well in our industry and every industry. This issue about setting expectations, having a plan, not doing too much integration, as I think both of you have talked about. this is critical. And these are common mistakes. That's great. So we've got just a few minutes left. I want to give you each sort of 2.5 minutes. Talk about what do you see next for software, whether it's M&A, products, market. Give me 2 minutes time. Let's go Thomas first, and then we'll finish with Mike.
Yeah.
What do you see? Give me 2.5 minutes of your vision for industrial inkjet and software.
Yeah, so we clearly see that the biggest demand among our clients in the industry, it's like the secret. It's not only the printing system. Yeah, the system is just the enabler, but everything upstream, the whole workflow and the way you design your business processes and you integrate it to actually take full advantage of digital printing itself. This is an area where there's plenty of work to be done, plenty of business opportunities in coming up with solutions, but also with additional services, professional services, consultancy in guiding customers to take full advantage. So this is a key area that also Colorgate and also Rico is focusing by now. The other thing is, of course, it's making solutions cloud available. So bring this all to the cloud, make it as a service. So this trend is continuing. So that's a key element. And of course, we're in the RIP business, RIP industry. It's still bandwidth is still an issue, but I think it won't last too long that this remains as an issue. Yeah. So with all the new technologies, 5G, etc., but also larger bandwidth. So that's a big trend. Great. And let's see. And also the 2D kind of color printing is entering into the next dimension. And can you remember when we were kind of sneak peeking this at the FESPA trade show?
I remember.
So 2.5D structure printing, texture printing. So these are also exciting areas that I think are really growing, and we're seeing more and more customers getting involved with this.
Phenomenal. That's great. Yes, I completely agree on the 2.5. Very interesting stuff. Mike, why don't you finish this up?
All right. So from my perspective, where I see software going in this space, first off, it's not just 2.5D. I think 3D as well. 3D has obviously gotten a lot of focus. Right behind it will be color 3D. And then there will be workflow for 3D and DFEs for 3D. And some of these are things that, companies in our group are working on already. So 3D is quite interesting and will continue to grow. I think, we make a joke that your world is hybrid, not a joke, but a statement. And I think that's true in a couple cases here. One is the cloud versus on-premise architecture of a lot of systems. Neither one is perfect. You can be in the cloud, but you've got a lot of data. So you almost need a hybrid topology on your solutions there. I also think that the revenue model of many software companies is hybrid. It used to be you weren't just looking at revenue, you were looking at EBITDA, and you were looking at SaaS versus perpetual licenses and churn and things like that. And more you see that most companies, I believe, have a hybrid revenue model. Some of it's perpetual, some is subscriptions, some is maintenance and support. And I think the end state of that will simply be most software companies look about the same in terms of their revenue model. Some percentages subscriptions and some are perpetual licenses. As far as growth areas for us, we see number one, turnkey DFEs as a main growth area. In the past, if you were building a digital device, you probably had to create a DFE, maybe with components like the Harlequin RIP, but you needed to create your own DFE just to make sure that the machine was working the way you wanted it to. But I believe the trend will be toward more turnkey DFEs so that the developers of inkjet printers can do what they do best, get new devices to market faster, and the DFEs will be more high levels of functionality, so they'll be more plug. I also think workflow, workflow is a broad term, but workflow, as we see it in labels and packaging, will extend to many other segments. How can you get jobs down from the web faster and out into manufacturing faster? And workflow really is the glue that ties those things together. And then finally, the last thing I think we'll see are other inkjet OEMs in different industrial segments pushing toward labels and packaging. Digital corrugated is a great example. There's a lot of development going on there because whether you're printing glass or ceramics, you could extend that technology into digital corrugated where we see a lot of growth. So I hope that helps.
Perfect.
Just to survey some of the changes.
I think it was right on the money. I love your points about workflow. I love your points about packaging. I do think turnkey DFE is a great point. You know, not everybody needs to do everything themselves, right? And as software expands, it makes complete sense. For our listeners, we hope that was enjoyable. At least some of us or all of us will be around to help you answer questions. I want to thank both Mike and Thomas for their time. I thought their insights were great. My view on M&A, software is going to be hot, right? People are understanding the value now. And just like we saw in my part of the presentation, how ink rolled up back in 2016, software is coming. Okay, software is coming. So both of you, thank you so much. Marcus and Fraser, thanks for giving us the time. And we look forward to talking to you soon. Thank you.
Absolutely. Thanks, everyone.
Thank you. Bye-bye.
Yeah.